Okay, so you sent over this article called "The Fed's Quiet Bailout Plan: Why It's Bigger Than 2008."
Mm-hmm.
And
It's from ITM Trading. Taylor Kenny's the host.
right, yeah, Taylor Kinney. And it kind of stopped me in my tracks because it talks about this potential crisis brewing, but it's not like the 2008 crisis.
Yeah, and the scale of it too, right?
Yeah.
I mean, we're talking potentially bigger than 2008. That's a
Yeah, that's the thing, right? It's like bigger than the Troubled Asset Relief Program.
multi-trillion-dollar.
Yeah. And so I was like, okay, we got to unpack this. We got to get you on, and we got to like really like go through this because it's a lot. And I think
There's a lot of moving pieces here.
yeah, there's a lot of moving pieces, and it's like, okay, what does this actually mean for like the average person listening?
Right.
So, I mean, where do we even begin?
Well, I think the article really centers around this thing called the basis trade. And I think
Oh, the basis trade? Okay.
yeah, and I think that's a good starting point, right? What is that? How does it work? So essentially what these hedge funds are doing is they're exploiting these tiny price differences between U.S. Treasury bonds and the futures contracts.
Okay, so they're looking for these like small little price differences.
Exactly.
And I'm guessing they need to make a lot of trades. Right?
Yeah,
Yeah.
to make any real return. Exactly. And this is where the leverage comes in. They're using extremely high leverage. We're talking 10 to 1 or more. So for every dollar they have
10 to 1.
10 to 1. So for every dollar they put up, they're borrowing 10.
Wow. Okay. So that really magnifies the potential gains.
Potential gains and losses.
Right. But also it makes me think about like how efficient is the market really?
Right. If they're able to exploit these tiny differences, right?
Yeah. It's like, well, how come these differences exist in the first place? Right.
Right. It suggests there might be some kind of market inefficiency there. And that's actually one of the interesting takeaways from this. It's like, regardless of what the trigger is for this potential crisis, the fact that these trades are so prevalent highlights this potential fragility in how even the most liquid markets actually work. It shows you that, well, maybe they're not as efficient as we think they are.
Right. So it's almost like a built-in weakness. Okay.
Kind of.
So let's talk numbers. The article mentions that hedge funds are currently holding about $1 trillion in U.S. Treasury securities. Now, that's a lot of money, but how much is that relative to the whole market?
So it's a significant chunk. That $1 trillion represents about 11% of the entire U.S. Treasury market.
11%. Okay. So they're not like a small player.
No, they're a major player. And the article says that if they were forced to sell those holdings, we could be looking at $8 trillion in assets being affected.
$8 trillion. Oh, wow.
Yeah, that's the interconnectedness of the financial system, right? Like one thing goes wrong here and it could just ripple.
Yeah. So, okay. We have these highly leveraged positions in a big part of the Treasury market. What could force them to sell and trigger that doom loop that the article talks about?
The article points to the growing tension with China as one of the major catalysts, the idea being that this geopolitical uncertainty makes the prime brokers, the institutions, lending money to the hedge funds nervous. So they start pulling back.
Okay. So they get nervous because of China. What do? They issue these margin calls, right?
Yeah, margin calls.
And that's when, explain margin calls for our listeners who may not know exactly what that means.
Okay, so it's basically like this. Imagine you bought a house with a mortgage, right? And then suddenly the housing market crashes, and your house is worth way less than what you owe on the mortgage. The bank might call you and say, hey, you need to put up more money, or we're going to have to take the house. That's a margin call.
Yeah.
It's the lender saying, hey, your collateral isn't good enough anymore. Give us more money.
More money.
More money, or we're going to have to liquidate your position.
Okay. And in this case, the collateral is the U.S. Treasuries.
Exactly. So if the value of those treasuries drops, or if the lenders just get really scared because of the China situation, they're going to start issuing margin calls to these hedge funds.
Okay. And so what happens if these hedge funds can't meet those margin calls?
Well, then they're forced to sell, right?
They got to sell.
They got to sell their U.S. Treasury holdings.
But aren't U.S. Treasuries supposed to be like the safest assets?
That's the irony, right?
Okay.
They're considered the bedrock of the global financial system. But when you have this forced selling, even these safe assets can plummet in value.
So it's like a self-fulfilling prophecy.
Exactly. They have to sell to meet the margin calls, which drives the prices down further, which leads to more margin calls, and it just spirals.
And that's the doom loop.
Yeah, it's the doom loop.
Okay. And the article also mentions this term bond market seizing up. What does that mean?
So imagine you're trying to sell something quickly, like your car. right?
Uh-huh.
And you need cash now. But no one's buying. No one's even answering your calls. It doesn't matter how low you drop the price. No one wants it. That's kind of like what happens in a seized-up bond market.
So there's no liquidity.
Right. There's no liquidity. No one wants to buy. Everyone wants to sell. And the whole market just grinds to a halt.
So this is like a real nightmare scenario.
It's not good.
Okay. So the article also talks about some warning signs, red flags. And one of them is this SOFR spread, which hit a record low recently.
Yeah, the SOFR. Secured Overnight Financing Rate. It's a key interest rate that banks use to borrow from each other overnight, using U.S. Treasuries as collateral.
Okay. Collateral again.
Right.
Yeah.
And the spread, that's the difference between SOFR and other interest rates that reflect credit risk.
Yeah.
So basically, it's a measure of how much more it costs to borrow money when there's more risk involved.
Okay, so the spread gets smaller when everything's going well and everybody trusts each other.
Exactly. It's like if you're lending money to your best friend, you probably don't need to charge them interest, right? But if you're lending money to a stranger, you're going to want some interest to compensate for the risk.
Right.
So a low spread usually means that there's a lot of trust in the system, and banks are willing to lend to each other at low rates.
So why is a record low spread a bad thing?
Well, it suggests that there's a shortage of safe assets. It's like everyone is so desperate to get their hands on U.S. Treasuries because they're seen as the safest thing out there that they're willing to lend money for next to nothing.
Okay.
And that can be a sign that liquidity is drying up.
Mm.
Banks are hoarding cash. They're not lending to each other. And that can make the system really fragile.
Right, right, because it's like they're afraid of what's coming.
Exactly. It's like battening down the hatches, right?
Yeah, yeah. Okay, so we have this potential crisis brewing, but the article talks about a bailout, a multi-trillion-dollar bailout. And I'm like, wait, if the problem is with hedge funds, why would we need to bail them out?
Yeah, it seems counterintuitive, right? But the thing is, hedge funds, they're not just isolated players. They're intertwined with the entire financial system.
Intertwined.
Yeah. And their failures could have a domino effect. So the article's argument is that the government might feel compelled to step in, not to save the hedge funds themselves, but to prevent a complete meltdown of the financial system.
Like a systemic risk.
Exactly. A systemic risk.
Okay, and the article even mentions that there's this hedge fund bailout tool that's been discussed.
That sounds like they're already preparing for this, right?
Yeah, it's like they see it coming.
Which is kind of worrying in itself, right?
Yeah, so it's not just
Yeah.
theoretical, they're actually talking about this.
Yeah. It reminds me of what happened in March 2020 during the COVID crash. Remember, the Treasury futures market went haywire.
Yeah,
The Fed had to step in and stabilize things.
Mm.
So it's not like there's no precedent for this.
right, right. Okay, so shifting gears a little bit, the article also talks about global trust in U.S. debt. What's going on there?
The article highlights this trend of declining demand for U.S. Treasuries from foreign buyers, which is kind of a big deal because historically, foreign demand has been a cornerstone of the U.S. debt market.
A cornerstone.
Yeah, it helps keep interest rates low. But now, the article says that demand is shockingly low.
Shockingly low.
Yeah. And that's a sign that maybe the world is starting to lose faith in the U.S. dollar and U.S. debt.
Okay, so if the rest of the world isn't buying our debt, who is?
Apparently, U.S. banks have been stepping in and buying up a lot of these treasuries, over 20% of recent auctions, according to the article.
Okay, so the banks are buying our debt.
Yeah, which is kind of shifting the risk from foreign investors to our own banks.
Right. So how is that a risk?
Well, remember we said about those unrealized losses?
Yeah.
If the value of U.S. treasuries keeps dropping, the banks are going to be sitting on a pile of losses.
Right. Okay, so that's where the Dodd-Frank regulations come in and this whole bail-in thing. That's where it gets scary for regular people, right?
Exactly, because Dodd-Frank allows for these bang-ins where instead of using taxpayer money to rescue a failing bank, they can just take money from the depositors.
They can just take money from depositors.
Yeah. It's like you thought your money was safe in the bank, but suddenly, poof, it's gone.
And the article gives some examples of this happening in other countries.
Greece, Cyprus, Lebanon. People's bank accounts were frozen. Their savings were devalued.
And there's even an example here in the U.S., right? The First National Bank of Lindsay.
Yeah, in Oklahoma. The article says that they used uninsured deposits to cover a funding gap. So it's not just a theoretical thing. It's already happening.
So if all these things happen, the hedge funds blow up, the bond market seizes up, the banks are in trouble, regular people with money in the bank could be in serious trouble.
That's the scenario the article is painting. And it's not pretty.
Okay. So what can people do?
Well, the article suggests a few things. First, don't wait for a crisis to happen. Start planning now. Get your financial house in order.
Okay, plan.
Yeah. Second, minimize counterparty risk. That means don't keep all your eggs in one basket. Don't rely on just one bank or one financial institution. Diversify.
Diversify.
Okay. And finally, consider holding physical assets like gold and silver, things that are outside the traditional financial system.
So basically, be prepared.
Be prepared.
Okay, so let's sum this up. This deep dive has been about the Fed's quiet bailout plan, and it's basically a warning about a potential financial crisis that could be even worse than 2008.
Right. And it highlights how this crisis could originate in the Treasury market because of these highly leveraged hedge funds.
Leverage again.
Yeah, leverage is a big theme here. And it shows how this could lead to a bond market crash, massive bailouts, and even bail-ins where regular people lose their savings.
So it's not just about the hedge funds, it's about everyone.
Exactly. It's about the interconnectedness of the system.
Yeah.
And the article also points to this broader trend of declining global trust in the U.S. dollar and U.S. debt.
Right. So it's like a perfect storm brewing.
Yeah, it's a lot to think about.
It is. So I guess the big question is, what's the weakest link in the chain? What should we be watching most closely? Is it the leverage in the hedge fund industry, the stability of the Treasury market, or the health of the banks?
It's hard to say, but I think this article makes a strong case that we need to be paying attention to all of those things.
Yeah.
Because they're all connected, and any one of them could be the trigger that sets off the next crisis.
Wow, okay. Well, thank you for breaking this down for us. It's been a lot to digest, but I think it's incredibly important for people to be aware of these things.
I agree. The more informed we are, the better prepared we'll be.
So everyone listening, I urge you to keep learning, keep asking questions, and stay vigilant. We'll be back soon with another deep dive into the forces shaping our world. Until then, take care.